You're watching us here on Markets Today, the show where we talk about the headlines for the day and the way the markets went. It was an interesting day of trade. The Nifty finally ended in the green, and we did see marginal gains come by for the frontline indices. So let's talk about those headlines itself. The Sensex and the Nifty end with marginal gains, even as banking stocks declined. The midcaps outperformed. It was reliance in L&T which lent some support, while ICICI Bank and Infosys dragged. Oil marketing companies extended their gaining streak. Hindustan Petroleum gains over 7%. Crude slips to a 3-month low following a sharp jump in the US inventories, an indication of economic weakness in China. Hindalco arm Novelis posted healthy volume growth and margins and shares a positive outlook, while Shree Cement reports in-line numbers but points to higher margins and capacity-driven revenue growth. A jump in margins drives up Apollo Tyres reports strong yearly revenue growth. Cummins too gains following robust guidance with favorable sales mix. Midcap Pharma Index buzzing on the back of better than estimated earnings, gains driven by Alchem Labs, Zydus Life Sciences and Newland Labs. I'll tell you what we have on the show for you. It's a packed show. In Market Opinion, we have Nilesh Shah, Managing Director at Kotak Mahindra AMC. Big Corporate Voices, we have H.M. Bangar, who's the Chairman at Shree Cement. Let's talk about the day's market action. Then it was a range-bound day which saw the Nifty and the Sensex end with minor gains. It was dragged lower by the Nifty Bank, which also had the weekly options expiry. Reliance and L&T batted for the bulls on the Nifty, while ICICI Bank and Infosys dragged the Nifty lower. We had the broader markets. Midcaps did extremely well, rallied almost 1%. The midcap index was higher and continued to move higher. The Nifty Bank ended mildly in the red. The midcap outperformance had helped the market breadth to be in favor of the advances itself. Prashant Nair joins in with a detailed wrap of the way the market was. Prashant.
It was a day for the broader markets more than the large caps, and you'll just see why. The Nifty ending higher by about 30 points or so. It was not a big range day. From the low to the high, the range today was about 65 points, and we ended about 30 off it in the green. Bank Nifty underperforming. It has been the weaker of the indices. It ended about 0.18% lower. Broader markets, mid-caps and small caps specifically running away, although off the highs, by the way, but ending and closing at a fresh high. Now, large caps, Nifty and stocks which did well. BPCL stood out. Oil marketing has been a theme, and we highlighted this on our Editors Roundtable program as to how these companies have seen large earnings upgrades post second quarter numbers. Adani Ports was another one. Asian Paints was the other one, which ended higher. In the broader market, lots of movers. Prince Pipes, second highest volume day since listing today. 15% move today. HPCL, again, the oil marketing theme. Apollo Tyres was a big gainer. GMDC, Alchem, they were earnings upgrades post numbers. Angel One has done very well. Poonawalla FinCorp, RR Kabil, big move. Moyle, Newland Laboratories, Viatech Vabag, Ratnamani Metals, EMS, recent sharp corrections, basically made up all of it. Iron Exchange was another one. So these are the big volume-led gains that we had in the broader space. There were losses as well. Mama Earth, which is Honasa, that ended lower. Second day, in terms of the listed life. Jayaprakash Associates has done well, but volumes were high and stock was saw pullback. GHCL, Idea Forge started weak, ended about 7% lower. There was Rain Industries, Midhani, Wonderla, Dhanuka, a few others. Not very much on the Nifty. We're slightly above the 20-day moving average as far as the Nifty is concerned. And the next resistance come in slightly above the 19,500 level. So those are levels you'll want to watch out for, provided global markets continue to stay as buoyant as they have been and oil prices stay as obliging. Back to you.
All right, Prashant, thanks a lot for that. We'll have to watch out for the global markets and oil prices. But let's get in some market opinion. Nilesh Shah, Managing Director at Kotak Mahindra AMC, says that though small and mid caps have done exceptionally well, they will need to halt a bit at current valuations. He's placing his bets on SIPs and large caps.
Some time back, we were worried about monsoon because August was dry. In September, rains recovered. Now, it hasn't reached to above average, but from deficiency of double digit, we are in mid-single digit deficiency. Undoubtedly, small and mid caps have done exceptionally well, and many of those companies have delivered also good results. But at this valuation, probably they will need to halt a little bit, so that there is a time correction when earnings catch up with the fundamentals.
All right, and he also is positive on the banking sector. He said that banking earnings have been fairly good, and he likes the capital goods place too. Let's hear him out on those.
in large cap companies, earnings growth momentum has not slowed down. In private banking, earnings growth has been fairly good. Many of these capital good companies are also becoming part of the global supply chain management through their parents or otherwise tie-ups. So they will cater to local market as well as global market.
All right, let's move on to the second big headline today. And the biggest reason why we did see a lot of these refiner stocks do well, that was because crude prices slid to their lowest levels that we've seen in the last 3 months. It was weighed down by a couple of things. One, concerns over waning demand in US and China. And secondly, a steep buildup in US crude inventory, also with mixed data coming in from China. Manisha Gupta joins in with why crude has declined to the levels that it has and what's the way forward. Manisha.
Well, the month of November hasn't started any better for the crude oil prices. After 10% decline in the month of October, November already has seen sharp cuts. 4% down in this week and 6% down in the previous week as well. So a 3-month lows coming in for the crude prices. The major factors pushing prices down are: one, the US inventories have gained up by 12 million barrels in the last 1 week. It also has to do with the weak Chinese export data that we've seen coming in this week, and the weak Chinese demand as well that has been weighing on. And then Israel is also considering tactical pauses with the Gaza conflict, so that geopolitical or the war premium that the crude prices were holding until the last month, when the prices almost went to $91 a barrel, seems to be going away as well. And we have seen a $10 decline since those levels, and we are trading around that $81 a barrel mark. The markets have seen a lot of volatility come in for the crude oil prices, but going forward, it all is going to be about on whether or not around these $80 a barrel will OPEC and allies make further output cuts. Remember, there have been concerns about deficit in this quarter, but with the demand weakening in China and US and Europe, the prices have seen decline. Also, the hedge funds were building position because of the war premium. They seem to be getting into profit taking as well, pulling the prices down. The markets do believe that we still are in a steady range. $78 on the lower side is going to be a strong support. There is just so many uncertainties in the global market that there is not too much of decline that you can expect from crude prices from these levels. But the $100 barrel kind of level with the street was talking about as of now seems to have been ruled out.
All right, $100 per barrel ruled out for now, and as a result of which we saw a big move in HPCL, surged over 7% today and rallied for the 9th straight session. The company has reported a good set of numbers in the second quarter, with margins and PAT beating street estimates. Separately, it's also planning to increase the refinery capacity at various locations. So what's causing this rally for the second day running? We have Sona joining in.
Thank you so much for that. Well, 9-day running for HPCL, where it has seen gains, highest level since July as well. Couple of reasons here. The first thing, of course, is the entire oil marketing universe has done well in quarter 2. For HPCL as well, it was a beat in terms of numbers. If I look at it, margins came in higher at 8.6%. Profits were higher at 5,100 crore rupees. Their GRMs at $13.3 per barrel were higher by around $5 to $6 per barrel, both on a YOY and on a quarter-on-quarter basis. Now, the second trigger for the company now is all the expansion plans. It has been on a capex spree in last 5 years, and now it seems to be reaping those benefits. It will be raising its refinery capacity, which will come on stream soon. One is at the Vizag refinery, where it's 7 million tons per annum, and they are also commissioning the Barmaid refinery, which is also a huge capacity as well. Mumbai refinery has also expanded from 7.5 to 9.5 million tons per annum. They've also commissioned 2 major pipeline projects in the south. They've also commissioned a regasification and storage terminal at Shara, and overall they plan to do a capex of 75,000 crore rupees over the next 5 years. And this, how will it be split? 20 to 25%, 25 to 30% of this will be in renewables, 20 to 25% in refining space, and balance on marketing. So they are looking at diversifying their current product portfolio as well. The third reason is they have actually put out, or they have commissioned, a wholly owned subsidiary for their green businesses, where they will be foraying into renewables, EVs, there's hydrogen segments, and crude to chemicals as well. And the last one is that they have spoken about lubricants demerger. It happened back in quarter 4 FY23. There's some update on that, where the company says they are awaiting certain approvals coming in from the government of India. They are looking on either listing it separately or actually looking at a strategic partner as well. So some value unlocking is what they are planning in the lubricants business. On the back of all this, the brokerages, they are quite positive. Nomura has raised the EBITDA estimates by 3% for FY25, 8% for FY26 on higher refining margins of the company. ICICI Securities has increased the FY24 estimates by 122% and FY25 by 17% versus previous estimates. The thing to watch out for the entire universe would be the elections, because that could pose some threat to their marketing margins. But for now, looking good for HPCL.
All right, now looking good for HPCL, 9 days running, and the stock is up and away. The other one in focus today was Hindalco, as its arm Novelis achieved its guided operating profit sooner than projected. The company's volume growth was low on a year-on-year basis, but did see some sequential recovery. And as a result of which, the stock ended about 0.75% higher. Nigel joins in with the details of those numbers. Nigel, over to you.
Well, that's right. Hindalco's subsidiary, Novelis, came out with a set of numbers and it looked rather good. Now, if you look at the volumes on a year-on-year basis, it was a little bit lower, but on a sequential basis, there's a good recovery of close to around 6%. And more importantly, the management says that the destocking exercise on the can segment, that seems to be over, and things should look up from here on. So that's good news. In terms of the EBITDA per ton, well, they were guiding that the EBITDA per ton will move to around $500 per ton by Q4. But guess what? They have done it sooner than estimated. So in Q2 itself, they've hit that target. And the key reason was, the spreads were in their favor. Volumes as well picked up, so then you had operational leverage that played out, and two of their geographies did very well. The North America as well as the European market, both of them on an EBITDA per ton basis did far better. Now, in terms of a guidance, they're saying yes, Q2 was good, but for Q3 they're guiding EBITDA per ton in the vicinity of close to around $450 to $500 per ton, while from Q4 onwards they're talking about EBITDA per ton moving to around $525 per ton. The net debt number, well, that's more or less stagnant at around that $4.4 billion odd. Now, in terms of brokerages, well, you have Jefferies, they have a buy rating, target price around 575. Equaris, they have an add rating, but they've gone ahead and they've tweaked their earnings estimates because of the beat out here. Similar is the case with Novama, though they have a hold rating on the stock, they've tweaked their estimates for the next couple of years upwards.
All right, Nigel, thanks a lot for that. In fact, let's move on and talk about Shree Cement as well. That met street expectations in the second quarter. The EBITDA came in shy of that 875 crore rupee mark. The revenues came in at 4,500 crore rupees as well. The street expectations were close to 4,400 crore. But the stock was lower on account of these results. Wonder why? Maybe some bit of profit taking. Nigel, tell us more about Shree Cement.
Well, that's right. Shree Cement's numbers were a little bit better, or more or less in line with what the street was working with. So on the top line, there appeared that there was a beat, and the EBITDA performance was more or less in line. But on the top line, though there was a growth of close to 21%, there was a part of that was contributed from the power segment. So on a like-to-like basis, actually the realizations were up by around 2 to around 3%. Sales volumes growth around 10%, and that's precisely what the street was working with. On an EBITDA per ton front, for the second quarter running, they've reported EBITDA per ton in excess of around 1,000 rupees. The profit number, though, looked much better than what we were working with. That's because the effective tax rate was lower on a year-on-year basis. And in terms of operational cash flows, well, there was a good improvement in the first half of this year if you compare it with the first half of last year. Finally, we spoke to the management and they indicated that the outlook for this year in terms of sales volumes, they're guiding for around 12% growth. They're saying the EBITDA per ton will only improve from here on. And in terms of expansion, they're saying most of it is going to be organic because as of now, they're not on the prowl. They're not looking at much inorganic growth.
Volume will be increasing by about 12% in the whole year. First half, it is higher by 14%, 13 to 14% in the first half. The second half will be little lower. So overall, the volume growth will be minimum 12%.
All right, with that, we'll take a short break, come back on the other headlines on the other side. Welcome back. You're watching us here on Markets Today. We spoke about a couple of earnings. We spoke about the oil prices and we spoke about the markets. Let's talk about some other stocks which were in focus, especially given the broader markets were upbeat today. Cummins is the stock that was on our radar, ended at the high point of trade with a gain of 4% on the back of its second quarter numbers. But more importantly, it was the management guidance that the company, the street liked as well. The company spoke about double-digit revenue growth going forward, along with improvement in their margins too. Upasana Bhatt joins in with the earnings report card and the key takeaways from the management call.
Well, Cummins India has reported its Q2 FY24 numbers and it's clearly a margin beat. There has been a margin expansion of almost 219 basis points at 17.8% versus the poll of 15.3%. While the revenue saw a downtick of almost 3%, somewhere around 1,899 crores, which was mainly due to weak export sales. Now, earlier this morning, company held conference call and here are some of the highlights. Well, the company sees double-digit revenue growth in FY24. It says that the margin expanded on commodity cost control and pricing will continue at the current levels. It also aspires to grow its margin by 100 basis points on Y-on-Y basis, and demand continues to remain robust in domestic market, which was one of the key concerns. It has also stated that more than 70% of the sales were from CPCB4 Plus products, and it expects the demand to normalize and sustain for the rest of the year. The demand for power generation sets is likely to remain robust, is what the company has indicated, and it is aiming CPCB4 Plus products to first enter EU, followed by US markets. In terms of inventory, the company has said that the inventory levels are back to normal levels and Q3 and Q4 are likely to be better.
All right, Upasana, thanks a lot for that. Apollo Tyres was the other stock which was higher by nearly 7% as the consolidated net profit of the company rose for the second quarter in a row. The company saw higher revenue and lower material costs in this quarter, just the way a lot of these, tire stocks have been reporting their numbers this time around. Sonia joins in with what drove Apollo Tyres higher.
Well, absolutely, the earnings were on track, and there are a couple of things which are playing out for Apollo Tyres. See, the top line growth is still in single digit, but the operational performance has been fabulous this time around. Same time last year they had 12% margins. This time it's increased to 18%. That's also because of lower crude prices, lower rubber prices that are used to make tires. And now even in today's trade, crude prices are below that $80 a barrel mark. Hence, all of that will aid Apollo Tyres in the quarters to come. If you remember, JK Tyres numbers were also very strong last week, and hence post that the expectation was that Apollo Tyres would do well. If you break it up into geographies, the Asia Pacific and Middle Eastern market is doing very well for Apollo Tyres. There's good growth that we're seeing in the EBIT performance. Although the European market is a bit on the slower side, the EBIT has actually fallen year on year, while the revenue growth is in low single digit. But all in all, good set of numbers, and looks like this trend of improving margins is something that can continue given the cooling off of crude prices.
All right, let's talk about the mid-cap pharmaceutical space now. All of them were abuzz. They extended their gains for the second straight session on the back of strong quarterly performance coming in, this time from companies like Alkem and Zydus Life. Ekta joins in with our daily dose of medicines.
Well, yes, a lot of mid-cap pharmaceutical stocks are buzzing, and one of the key themes playing out is better than expected numbers. So, for example, Alkem, the revenue was up around 12% to 3,440 odd crores. Alembic, which was up around 8% in terms of sales, was better than estimates of around 6%. Newland, which was up 42% on a year-on-year basis, showed strong sales in the previous quarter. Even margins, Zydus 26% versus estimates of around 23-24%. Alkem 21.7% versus estimates of around 16%. Newland Labs 33% versus 24% year on year. JB Pharma 27% versus 22-23% on a year on year basis. Guidance has improved for all of these companies as well. So, for example, Zydus has retained its double-digit growth guidance for the US markets for FY24. They aspire to achieve $100 million in terms of revenue from the rare disease portfolio in 3 to 5 years. Alkem, the company has retained its guidance of high single-digit growth for India in FY24. They've marginally raised their guidance for margins to 16.5% versus 16% earlier for this fiscal. Alembic, the company is guiding for high single-digit to low double-digit growth in India, and according to them, price erosion is bottoming out. Brokerages are positive. For example, Zydus, CLSA has downgraded the stock to outperform, but they raised the target price. Motilal Oswal is neutral with a target price of 660. Alkem, Nomura has upgraded the stock to buy. Alembic, Motilal is neutral with a target price of 710. In terms of valuations, all of these stocks have seen a strong run-up from their 52-week lows, especially something like a Newland Labs, which is up around 272%, and are trading anywhere between 18 to around 22 times when it comes to FY25 PE.
Right, and then let's wrap it up with the CNBC-TV18 exclusive, where we understand that Relicare Enterprises has likely kickstarted the process to list its health insurance arm, Care Health, on the bourses. Sources tell us that the company is actually looking to raise between 1,500 to 2,000 crore rupees. The IPO will consist of both primary and secondary issuance, and its proceeds will be used to enhance its business. Yash is with us with the details.
Well, Mangalam, of course, you would remember that very recently Relicare Enterprises successfully completed the one-time settlement process for Relicare Finvest. Now what we've been given to understand is that another subsidiary on the health insurance side, that is Care Health Insurance, the process for its IPO has been initiated by Relicare Enterprises. What we've been given to understand is that bankers have been invited to make IPO mandate pitches as far as this particular public issue is concerned. And as you mentioned, the company is looking to raise about 1,500 to 2,000 crore. When it comes to this particular IPO, it will have both primary and secondary sale of shares. As far as the primary sale of shares is concerned, Care Health Insurance wants to use this money towards enhancing its solvency margin. Also, as far as some of the funds are concerned, towards supporting the growth which it sees in the Indian health insurance market. As far as the secondary sale is concerned, most importantly, Relicare Enterprises is also likely to sell partial stake when it comes to this particular IPO. Along with Relicare, other investors are also looking and exploring the opportunity to sell or pair their stake shareholding in Care Health Insurance. Just quickly look at the shareholding pattern. Relicare Enterprises owns about 64.5%, Trishkar Ventures owns about 16%, Union Bank with about 5.5%. Anuj Gulati, who is the MD and CEO of Care Health, owns about 4%. Rashmi Saluja, the chairman of Relicare, who also owns about 1.5%. And finally, Ashish Dhawan owns about 2.3%. As far as the valuation is concerned, Care Health trades at a book value of about 1,900 crore rupees. A listed competitor, on the other hand, Star Health, that trades at a price to book value of 5.8 times, and you'll see a chart on your screen with respect to the valuations of anywhere between 4 times price to book value to 7 times price to book value, which will value Care Health anywhere between 7,600 crore rupees to about 13,335 crore rupees. Of course, Relicare stake also accordingly will be valued between 4,900 crore rupees to about 8,500 crore rupees.
All right, Yash, thanks a lot for that. So that's about Relicare. With that, we'll wrap up on this edition of Markets Today. You stay tuned to CNBC TV18 for more news and updates.